Hey everyone, welcome back to The Explainer. If you've been keeping tabs on the Indian business and edtech space, you already know there is one absolute behemoth of an event on the horizon. Today, we're diving headfirst into the highly anticipated, incredibly dense Physicswallah IPO prospectus. We're going to take hundreds of pages of heavy legal and financial disclosures and, well, translate them into exactly what you need to know. It's a truly fascinating look under the hood of a massive company transition.
Okay, let's dive into this and lay out our roadmap. We're going to break this all down into 5 logical steps. First, unpacking the IPO itself. Then, looking at the fresh issue versus the promoter's sale. Next, we'll check out the deal architects, move on to how they're slicing the IPO pie, and finally, we'll wrap up by understanding the risks involved.
All right, Part 1, the Physicswallah IPO unpacked and the sheer scale of this offering.
34.8 billion rupees. Let that sink in for a second. When we talk about Physicswallah entering the public market, this is the massive top-line number that we're deconstructing today. It's a monumental financial milestone for them, and it's absolutely crucial for understanding the rest of this prospectus.
So, Physicswallah is officially making the leap from a private company to a public limited one in early 2025. And to hit that 34.8 billion rupee target, they are offering a staggering 319.3 million equity shares. Now, through the book-building process, they've set the cap price at 109 rupees per share. That's the baseline for the whole deal. But it begs a really important question. Where is all that cash actually going once those shares are sold? Which brings us to Section 2, fresh issue versus promoter sale. Where exactly is the money going?
Before we throw more numbers around, let's quickly bust some financial jargon. An IPO of this type is essentially made up of 2 distinct parts. First up, you have the fresh issue. These are brand new shares created by the company specifically to raise capital for itself. The second part is the offer for sale, or OFS. This is when existing owners sell shares they already hold. The key takeaway here, in an OFS, that money goes straight into the pockets of the selling owners, not into the company's bank accounts.
And this brilliantly illustrates the split. The vast majority of this IPO is a fresh issue. A whopping 31 billion rupees is going directly into Physicswallah to fund its operations, expansion, you name it. The much smaller remaining slice, the offer for sale, makes up just 3.8 billion rupees. So the company is clearly getting the lion's share of the capital. But we got to ask, who exactly is taking home that 3.8 billion? Well, it's the promoters. Alok Pandey and Pratik Boob are the ones cashing out here. They're each selling exactly 17.43 million shares, which means they are pocketing 1.9 billion rupees apiece. But here's a truly fascinating detail buried deep in the auditor's notes. Their weighted average cost of acquisition for these shares? The prospectus literally lists it as negligible, specifically below 0.01 rupees per share, less than 1 paisa. I mean, building a company from the ground up to a massive public offering is just a phenomenal wealth creation event for the founders.
Moving right along to Section 3, the deal architects and the institutional weight behind this IPO.
Listen, you don't just manage a 34.8 billion rupee transaction without some serious financial muscle. We're talking about the book-running lead managers. Physicswallah has brought in heavyweights from both the global and domestic stages. Having giants like Goldman Sachs and Kotak Mahindra Capital leading the charge, that signals incredibly strong institutional backing to the broader market.
And rounding out that top-tier team, we've got JP Morgan and Axis Capital. These 4 institutions are the ones responsible for everything. Assessing market demand, setting the final price within the band, making sure the shares are actually allotted to investors. The whole shebang. It literally takes an army of financial architects to orchestrate a public debut of this magnitude.
And they have to execute it fast, like incredibly fast. This entire public bidding event happens over just a few days in November 2025. Anchor investor bidding opens for a single day on November 10th. Then, the main bid and offer period opens to the public on Tuesday, November 11th, and it slams shut on Thursday, November 13th. A multi-billion rupee deal opening and closing in the blink of an eye.
Let's move to Section 4 and see how this builds out. Slicing the IPO pie. Who gets what?
SEBI, the securities regulator, has very strict rules on how IPO shares are handed out, and Physicswallah's structure here is incredibly rigid. A massive 75% of the net offer is locked down, reserved exclusively for qualified institutional buyers. Think large mutual funds, banks, the big players. Up to 15% is set aside for non-institutional bidders, like high-net-worth individuals, which leaves a maximum of just 10% for retail individual investors. That's the everyday folks watching the market who want to buy in.
But I actually spotted a really neat internal detail in there too. The prospectus outlines a special reservation of over 700,000 shares specifically for eligible Physicswallah employees. And as a perk, those employees are getting a 10 rupee discount per share off the final offer price. It's just a really structured way to let the people who actively built the company participate directly in the upside of the IPO.
Finally, Section 5. Time to bring things back down to earth and look at the fine print. Understanding the risks.
So, the crucial point here is that every single prospectus is legally mandated to outline risk factors, and this document pulls absolutely no punches. First off, this is their first public issue. That means there is zero formal market history for these shares. Second, that 109 rupee cap price we talked about, that's just determined by the company and the lead managers. It guarantees absolutely nothing about what the actual market price will be once it starts trading. Third, there's no assurance of an active or sustained trading market. And finally, the golden rule of investing is explicitly stated right there in black and white. Equity investments always carry the risk of total loss. Regulators aren't guaranteeing the accuracy of the prospectus, and they certainly aren't guaranteeing you a return.
Which leaves us with one massive, thought-provoking question. We're looking at a 34.8 billion rupee offering, almost 320 million shares in play, and completely zero prior market history. So, will the public market actually validate Physicswallah's valuation? The founders are cashing in a portion, the heavy-hitting banks are locked in, and that rapid-fire timeline is set for November 2025. It is going to be absolutely fascinating to see how the market responds to everything we've just unpacked today. Thanks so much for joining me. Keep exploring the data, and I'll see you on the next explainer.